Dear viewers, good day. This video is about the economic consequences of COVID-19. The outbreak of COVID-19 and resultant lockdowns in almost every country of the world has led many to believe that situation like Great Depression of 1930s may be in the offing. International organizations like the IMF, the World Bank, OECD, they are warning governments about the possible happening of such a scenario where a large number of world economies, especially those hard hit by the COVID-19 lockdowns, may collapse, resulting in high unemployment rates, low GDP growth rate, and massive inflation. All these scenarios may be quite frightening for a majority of the people living in the 21st century. Let us explore the probability of a second Great Depression based on historical events and principles of economics and finance. I will analyze the whole situation in 7 segments for easy comprehension. But before we move forward, you may like to subscribe my channel for future updates. Many of you may wonder what an economic depression is. In simple words, economic depression may be defined as a situation where economic activity falls to a significant low compared with earlier fiscal periods, and this situation persists for several business cycles. Naturally, when there is a fall in economic activity, it would result in fall in people's income and wealth. Besides, many people will be forced to spend their savings to survive, and a large segment of population in a country may become poor. Since all of us fear poverty, therefore economic depression may be a point of concern for all of us. What were the causes of Great Depression of 1930s? Well, without putting forward the debate between the Keynesian and monetarist school of thoughts, there were explicit factors that triggered this event. Out of numerous factors, the 5 key events were: 1. Stock market crash of 1929. The stock market crash of 1929 that was primarily caused by persistent overtrading by the stock buyers in the hope of a further rise in stock prices was a catalyst. 2. Banking panics and monetary contraction that was caused by the fact that people became panicky and started withdrawing money from banks, and the bank's ability of credit creation reduced significantly. It may be noted that banking and stock markets were not meaningfully regulated in those days. 3. Balance of payment imbalance caused by the gold standard. Deflation in the US led to a trade surplus and flow of foreign gold to the US. Accordingly, foreign central banks attempted to counteract the trade imbalance by raising their interest rates, which had the effect of reducing output and prices and increasing unemployment in their countries. The resulting international economic decline, especially in Europe, was nearly as bad as that in the United States. 4. The protectionist measures. Another relevant factor was decreased international lending and tariffs as part of protectionist measures taken by the United States that were retaliated by other countries. 5. Drought and famine. It may be remembered that the 1930s saw natural disasters as well as man-made ones. For most of the decade, people in the plain states suffered through the worst drought in American history, as well as hundreds of severe dust storms or black blizzards that carried away the soil and made it all but impossible to plant crops. By 1940, 2.5 million people had abandoned their farms in this dust bowl and headed west to California. It may be of interest to you to know that the quantified economic effect of Great Depression between 1929 and 1932, almost 36 months, was an estimated reduction of 15% in world GDP, or gross world product GWP. Interestingly, the size of GWP in the 1930s was estimated to be $2.2 trillion compared with today's GWP of more than $80 trillion. So, a 15% reduction in present times in 3 years would imply a contraction of about $12 trillion in GWP. However, since the average time of lockdowns in any country is 4 months compared with 36 months of 1930s, therefore the contraction in world economy due to COVID-19 should not exceed $1.3 trillion. The maximum reported losses by beach stock companies until now are in billions only, far away from $1 trillion figure. In this segment, I will compare the structure of world economy in the 1930s and the 21st century against few critical benchmarks So let us explore. 1. Economic sectors. During 1930s, the world economy was primarily dependent upon the primary and secondary sectors, while in the 21st century, the service or tertiary sector plays a dominant role, creating almost 60% of world GDP. The primary and secondary sectors are comparatively considered rigid when compared with the service sector that is agile and flexible to environmental changes. 2. Labor force profile. During 1930s, major chunk of labor force was employed in large manufacturing sectors or associated with agriculture, while in the 21st century, the major employment sector is the service sector, where 60 to 70% of workforce in each country is engaged. It may be noted that the service sector is much more diversified and flexible when compared with large manufacturers and the agriculture sector. 3. Large scale versus small businesses. In the 1930s, major portion of businesses were large companies, while in the 21st century, small businesses dominate with 98% share and employing about 50% of labor force in the world. Closure of one large business may lay off thousands of employees in one go, while this may not happen in the case of a small business. 4. Role of information technology. During the 1930s, the role of information technology as a facilitator for business was minimal, while in the 21st century, information technology has become the backbone of every business activity and process. This implies doing online business during lockdowns without being closure. 5. Changes in business processes. The 21st century business processes have given birth to new ways of doing businesses through outsourcing, e-commerce, and multiple supply chains. All these changes have opened a new world of business opportunities with a lot of diversity. So diversity and flexibility, despite interdependence between businesses, have become a shield against one big economic fall. Based on the discussion so far, it appears that COVID-19 lockdowns may not push the world economy into Great Depression comparable to that of 1930s. Well, there are additional factors to support this argument. 1. Impact of COVID-19. The COVID-19 is affecting different countries in a different manner. For example, the US, China, and Western European countries are most hard hit by the COVID-19 as compared to a large number of Asian, African, and South American countries that have the highest world population and demand for goods and services. 2. Categories of lockdowns. There are also different categories of economic lockdowns enforced by different countries, ranging from complete lockdown in few regions, partial lockdowns in other regions, and even no lockdown in certain regions. So economic activity has not completely stalled in every part of the world. 3. Role of online businesses. Even in lockdowns, all online businesses are open, while many businesses like banking, insurance, training, education, and other professional services have switched to online mode. This implies at least 50% of economic activity is still going on in the lockdown. 4. Duration of lockdowns. Relying on Chinese experience, the expected duration of lockdown in each country is around 4 months. Compare it with a decade-long famine in the US during 1930s that was a contributory factor in bringing about the Great Depression. So the economic meltdown from a 4-month lockdown will be lower when compared with the long duration of the Great Depression of 1930s that lasted almost 4 years. 5. Role of industry regulators. Nowadays, the banking sector and stock markets are much more regulated by different countries of the world than what it used to be the case in the 1930s. So again, the probability of tremendous crash is minimal. 6. Role of service sector. The service sector is the largest employer and contributor in world GDP in the 21st century. That implies low risk of economic depression due to diversity in business sectors, business operations, and possibility of quick recovery and flexibility in small business sector. 7. Public sector development programs. Governments all over the world are ready to accelerate public sector spending once the lockdown is over. This will kickstart economic activity in a short span of time, and in the most likely scenario, major economies of the world will recover in 1 or 2 years after the lockdown. Some of you may be interested to know which industries are likely to be hard hit by the COVID-19 lockdowns. Although it is difficult to pinpoint specific industries that may suffer the most damage from COVID-19 lockdowns, yet companies in the travel and entertainment sector, so-called beach stocks, are some of the hardest hit. These beach stocks have seen more than $332 billion in value evaporate in just over the past month. The examples of beach stock include booking, entertainment and live events, airlines, cruises and casinos, hotels and resorts. The final question may be, which economy would lead the world after COVID-19? China or the US? At present, US and China are the two largest world economies competing on various economic and political fronts. Even the outbreak of COVID-19 is being debated as a sinister move on the part of either of these two countries to win the 21st century economic war. Since in the global economy, international trade plays a pivotal role for economic growth, therefore the size of foreign exchange reserves possessed by a country may be relevant in this context. China has the largest foreign exchange reserves, close to $3.3 trillion, while the US does not need these reserves because its currency is the most acceptable currency in the world trade between different countries. The share in global economy may be another determinant. Judging from this perspective, the US has around 23.6% share of global economy, while that of China is 15.5%. So logically, it takes time before China overtakes the US economy in global share. Based on this analysis, the following three conclusions seem plausible. 1. The COVID-19 lockdowns may not result in a Great Depression of the intensity of 1930s. The maximum impact may be a varying degree of recession experienced by different countries of the world, and even that would be a temporary phase lasting for 1 to 2 years. 2. The countries that have the most diversified portfolio of business sectors are less likely to suffer in the aftermath of COVID-19. This is based on the argument that diversity leads to greater absorption of risk. 3. The US will remain the largest economy of the world at least in the next 5 to 10 years. However, the gap between the size of Chinese economy and the US economy will continue to decrease, leading to a shift in economic and political power base in the world. If you enjoyed the contents of this video, do subscribe my channel for updates. Thank you for watching.